Are you struggling to find the right broker to take advantage of opportunities in the market? Are you looking to trade commodities, shares, or even crypto? Even if you don't know much about trading, you can learn all about it by visiting capital.com's website. That's capital.com. Capital.com is a global trading platform with over 500,000 users. Visit capital.com and start your trading journey today.
We do look for people who have this quality of kind of radical self-belief, right? They just like believe in themselves very profoundly. Truly, it's a level of self-confidence that will allow you to kind of run through brick walls and do impossible things and still believe in yourself when 50 people in a row say no to your idea. You know, that radical self-belief, I think, really matters. But it has to be kind of married with or coupled with a deep intellectual curiosity about the world, where you don't just assume you know every answer to everything, but you're actually really curious in how things work and why they work that way. Because I think intellectual curiosity is ultimately what manifests later in careers as humility and even sort of servant leadership. And so those two things together are a very powerful combination. That's kind of a superpower if you put the two things together.
Hi, everyone, and welcome to Conversations with Loulou. My guest is Alan Taylor, the managing partner at Endeavor Catalyst, a $500 million fund based in San Francisco and investing in the world's emerging markets. Endeavor Catalyst is part of the global Endeavor Network, a mission-driven nonprofit organization focused on supporting high-growth entrepreneurs in the world's emerging and underserved markets. Over its 10 years of operations, Endeavor Catalyst has made over 300 investments in 37 countries. 51 of these investments are unicorns, 12 are publicly listed companies. 1 in 6 companies in their portfolio is a unicorn. Alan and I are going to be discussing venture capital, their investment thesis as a co-investment fund. How does MENA compare with other emerging markets across the world? And we're going to talk about advice for fund managers and entrepreneurs, so tune in. So welcome to the show, Alan.
Thanks for having me.
That's great that you found some time on your regional trip to stop by.
Yeah, no, I'm very excited to be here. Always love coming to Dubai, so fun to sit and talk with you.
Good place to be. So look, I thought we'll start by talking about what Endeavor is and explaining, what you do to our audience who are not familiar with it.
Sure.
And I just thought, I got this from your deck and I wanted to read it and I'll ask you to comment on it.
Okay.
But from the Endeavor's deck, I read that we are the leading global community of, by, and for high-impact entrepreneurs, those who dream bigger, scale faster, and pay it forward.
Absolutely.
So can you tell us a little bit more about that? Can you expand on that a bit?
Yeah, sure. I mean, look, Endeavor is all about founders, all about entrepreneurs. So we are a worldwide organization. We've been around now 26 years. But the theory of change is essentially that entrepreneurs change the world, and we are trying to help. And so that language that you read is actually very intentional. We talk about being of, by, and for entrepreneurs. But it really is a community of founders who are building not just startups, but what we call scale-ups, right? So companies that actually get very, very big and have a big impact, because we think that's how you create jobs, create wealth, create economic opportunity, and frankly, create role models. So sort of success stories so that the next generation can look up to them and say, hey, wait, if she can do it, if he can do it, maybe I can do it too, right? And that's a big part of what Endeavor is all about.
Yeah. And when you talk about entrepreneurs, it's not only tech focused, right?
That's right. So Endeavor actually is industry agnostic. Yeah. So we can support any type of company that we think can really grow. It's interesting as tech and tech-enabled businesses have really come to more places over the last couple decades. More of our portfolio is tech-focused, but it's not exclusive, right?
Yeah.
And we support retail chains and chains of restaurants and anything that can really get scale and be that kind of high impact entrepreneur that we're talking about.
Because that's typically the critique that I hear. It's like, all you VCs, you only want to invest in tech companies. What about the entrepreneurs building other types of ventures?
Yeah, I mean, look, it's a fair critique, right? Venture capital is a very specific category of financing for a very specific type of business that honestly is only appropriate for kind of a narrow set of companies. We'll get into it, but we run a venture capital fund built on top of Endeavor. Within that, we invest in a subset of Endeavor's portfolio that is sort of appropriate for venture with the speed you need to build, the timelines it needs to follow, et cetera. But Endeavor is much broader than that, right? So to give you a sense, over the last couple of decades, Endeavor has screened and evaluated and looked at, I think it's something like 150,000 businesses. We've actually selected about 1,500 of them into the network. So it's like the top 1%. But then even within that, not all of them are appropriate to be venture backed, right? So we coach lots of founders and mentor, entrepreneurs who are bootstrapping their companies or financing them in different ways. But then within that 1,500, we've actually now written a venture check, Series A, B, or C, into about 300 of them.
So what is a company that qualifies for venture investing? Let's clarify it a little bit.
Yeah, well, look, I think for people who are listening who aren't familiar, venture is a very specific asset class, right? We as GPs or general partners of funds raise money from limited partners, and we make a deal with them, right? Where we say, hey, we are going to invest this capital over the next 2, 3, 4 years, and then you're going to make money back within a 7 to 10 year window. And that is totally appropriate for software businesses, for some types of technology businesses, for some types of tech-enabled businesses, that they will kind of move through to a liquidity event, an IPO or an acquisition, in that kind of 7 to 10 year time frame.
Yeah.
But for
so they need to grow very, very fast.
You got to go fast, right? I mean, so the famous like triple, double. I mean, you're growing like 200-300% in the early years to be a quote venture backable company. And I think as venture has gotten more mainstream and people talk about VC, frankly, in a lot of parts of the world where we work in Asia or Latin America or here, there might be even an over application of VC, like, oh, VC for everything.
Yeah.
It's not really for everything, right? It is for kind of a certain type of business that grows in a certain way.
Yeah, absolutely. So let's talk a little bit about your fund,
Sure.
which is, I know you manage $500 million for funds. And you have
Sounds like a lot when you say it that way.
Yeah, it is a lot. So what I found extremely interesting is your investment strategy. So it's a co-investment fund.
Yeah.
So can you tell us a little bit about that as well?
Yeah, sure. So the fund is called Endeavor Catalyst. It is the fund of Endeavor.
Yeah.
And so, like I mentioned, it is built kind of on top of everything Endeavor's been building over all these years. And frankly, we couldn't operate this strategy without Endeavor, right? Because Endeavor has local teams in, now 40 different countries. We have offices in 63 cities. We have something like 600 full-time team members, including obviously here in the UAE, but I was in Saudi yesterday. We have a full team of 15 people there, in Egypt, in Lebanon, in Jordan, Tunisia, all these places. And so what the fund takes advantage of is essentially that Endeavor is already doing a tremendous amount of work to find and select the highest potential entrepreneurs into this community and into this network. And so the fund then comes and says, hey, once you actually get selected and invited to join Endeavor and be what we call an Endeavor entrepreneur, you're essentially automatically eligible for the fund to invest in your next equity round if you are the type of company that's going to go raise a Series A or B or C. And in fact, we'll do more than just invest in it. We'll actually help you find the right investors for that stage, right? And once you're getting to Series B or C stage, that oftentimes is international funds who aren't present in your local ecosystem. And so we basically, for the companies that are a part of Endeavor, we say, hey, the next time you go raise money, we'll kind of commit up front, but then we want to try to attract a world-class investor who brings not just capital, because cash is kind of the commodity, but brings knowledge, networks, expertise, know-how around this stage of scaling companies. And so the same thing here in the Middle East. We are really trying to attract, call it the, Sequoia, Accel, Lightspeed, like best venture capitalists in the world to be more active in the region, but also the General Atlantics, right? Kind of the later stage growth equity funds to be active here. And we've had some success doing that. We can talk about it. But that's kind of the way the whole strategy is set up. We end up investing, $1 or $2 million. $2 million is our biggest check in these rounds of 10, 20, 40, 100. So we're not a huge check, but we are kind of a signal to the market that, hey, you can invest in these other geographies.
Yeah. And why is it that you don't lead around? So why is it that there would be a lead and then you are rules-based type co-investing, no questions asked, right?
So the main
as long as they're an
reason-
Endeavor company.
Yeah, so the main reason is we are not trying to be a standalone venture capital fund, right? I always say Endeavor is not a fund. We have a fund. And what I mean is the core program is still about this network of founders that we want to help, we want to support. Frankly, we want to connect them to each other, right? And build kind of the world's greatest peer network of high growth entrepreneurs and founders. And the fund is almost a program, if you want to think about it like that, of Endeavor. And so, the most important thing to us when we were setting up the fund 11, 12 years ago was that we didn't want to change the nature of our kind of trust-based relationship with all these founders. And so that's why we're not a lead investor. We don't price, we don't set terms. We're not actually trying to negotiate with our own companies. Rather, we're trying to bring the best investors to the table and then actually sit on the founder's side of that table and help them get the best deal they can, and then we join that deal.
Yes. Okay. So
Does that make sense?
Yes. So you also don't want to be in a position where you are investing in some and not in others, which may send the wrong signals as well.
Actually, interesting story. But if you do the history, the idea of investing in the Endeavor companies has been around since the beginning of Endeavor. But for the first 15 years, we had a very strong view that it wasn't something we could do. And the main reason was what you just brought up. We thought, well, we can't pick and choose among our community, right? We've already selected these people in and invited them. We can't say, oh, we're going to invest in that one, but not this one.
Yeah.
And so the rules-based system, which was actually the idea of Reid Hoffman, the co-founder of LinkedIn.
Who sits on your board.
Who's an Endeavor board member, and he's the chairman of this fund. He and together with a guy called Nick Beim, who's a New York-based venture capitalist, they basically said, well, what if we just made it a rules-based thing, right? So then you weren't picking and choosing. You were basically making the same commitment to every Endeavor company, and then you're letting the market sort of dictate which ones you invest in, and frankly set the price and the terms and things like that.
Because that's one of the main challenges of VCs as well. Because as I invest in companies now, one of the questions that the investors that come with me in the syndicate is that who is reinvesting from their previous investors, especially if they've had institutional investors on board. And there could be many reasons why these people are not reinvesting. Maybe their funds redeployed or I don't know, maybe they don't want for whatever reason. But it sends a signal.
Yeah, look, I think people oftentimes are looking for different social proof around different financing rounds.
Yeah.
And hey, are the inside investors investing more is like one of the key questions people ask a lot.
Yeah.
Being rules-based has helped us because every Endeavor entrepreneur, and we've made, like I said, 310 investments now, they know we play by the same rules.
So just to wrap up on the fund, there's an interesting point here on the fund economics. So you don't take the typical 2% in management fees, 20% carry.
Yeah, it's very different. When we started the fund, we said, hey, we want to help. Obviously, the number one reason to start this fund is help entrepreneurs, right? That was our primary goal. The number two reason was, can we make the ecosystem stronger, right? Can we bring high quality, smart connected capital into these different places? But then number three, importantly, was, can we build a business model that actually helps fund the nonprofit? And so that drives the decisions we made around the fund economics and the setup, which is, it is a standard GP-LP fund, meaning we are the GP. Endeavor itself is the management company and the general partner of the fund. But then when we raise LP capital from limited partners, we actually ask them to sign up for a fairly different arrangement than your standard fund, right? And so the first part is we don't charge them the standard 2% every year management fee because Endeavor already exists, right? So we're piggybacking on Endeavor's existing footprint. We charge some expenses back, but it's much less than the standard 2% would end up being. But then on the carried interest piece, we charge a premium carry, 50%, 50, and then we donate 100% of that money back to Endeavor. And so it really is kind of a share the upside model where, if you invest in us and, let's say we're able to 5x your money, You're still going to do incredibly well financially because you're going to get your principal back. And then, if we take $1 and we turn it into 5, of those $4 of profit, you get 2, right? You get half. So you've tripled your money. And then over here, we've made another $2 to fund Endeavor's future.
Yeah. And you've had an incredible hit rate as well. I mean,
it's working. It's fun to talk about.
It's unbelievable. I mean, I said it in the introduction, 1 in 6 companies in your portfolio is a unicorn, which is amazing.
Yeah, I mean, we can talk about that word. I don't know if unicorn is going to have lasting power into the next decade. But yeah, 1 out of 6 of the businesses, so more specifically, 51 out of the 300 have grown up to be $1 billion company so far. We think there are others on their way. But yeah.
But that's incredible.
This was really kind of it was a pilot or an experiment of sorts a decade ago of saying, hey, we know Endeavor has great founders. Can we build a venture fund on top that will be a high-performing, top tier, top quartile type fund? And so far, knock on wood, right? 11 years in, the answer is a resounding yes. Right? Our very first little pool of capital, kind of our beta fund we started out with,
which was $10 million?
Was $10 million. So far we've turned that into $86 million. Wow. Realized returns, right? So those in the industry, that's DPI, right? Like money back to everybody. And those were investing in companies in Brazil and Argentina and Turkey, right? So this was not investing in Silicon Valley. And so I think it is kind of proving out this thesis that, you can build really amazing companies from anywhere.
I saw that your highest return company, basically your highest return investment, was a company in Mexico. What is it called? A Corner Shop?
That's called Corner Shop. It was a grocery delivery business. People are familiar with the model. But it was acquired by Uber for $3 billion. The really kind of interesting piece of that is that that's a team of founders, actually from Chile originally, who this was the 3rd company we'd kind of done with them. Right? And so it emphasizes this point of like, once you become an Endeavor entrepreneur, it's not an accelerator program. It's not like a 6-month thing. Like, you're an Endeavor entrepreneur for life. And so in the case of the Corner Shop founders, we backed their first company, which they sold the group on, kind of like a medium exit. We backed their second company, totally failed. And then their third company became a $3 billion exit.
Interesting. And you would still back them again?
We'll back them again, yeah.
So I think because you said something very important, because the second company failed, and then the third company, you still backed them, and they made a fantastic exit.
Yeah, I think it's a really important point for this part of the world, and frankly for a lot of the places where Endeavor works. Failure is part of this, right? I mean, we are going to make a lot of bets and try a lot of things. And innovation involves, taking risks and trying a lot of this new stuff. And it doesn't always work. Yeah. And even, frankly, some of the big success stories, that make it to a certain point don't ultimately become huge successes, right? And I think that's okay. And I think that's actually something that's worth talking about, that, failure is part of this. The exaggerated version in Silicon Valley sometimes is to say, you have to celebrate failure.
Or fail fast.
Yeah, I don't know. I don't actually think you want to celebrate failure.
Yeah,
like, failure sucks.
Yeah.
Like, it hurts. But you have to have the kind of values within the community that you pick people back up, you help them do what's going to be next. Yeah. And you show that real kind of resilience, right, to do it again. What's
the discussion like when that happens in your portfolio companies?
Look, it's very real. Like, Endeavor is lucky. We have a fantastic kind of hit rate of success where, the vast majority of companies have been successful. Mm-hmm. But if you do hundreds and hundreds of these, like, you have dozens of failures over time. We always talk about, really prioritizing the person first, right? And so when things are not going well, we sort of double down on the personal founder support side of what we're doing, like making sure the person's okay, even from a mental health perspective, like, do you have support from your family, from your kind of immediate community? And one of the things Endeavor does is right away we let people talk to other founders who've been through something similar, which is a super important thing, because I think at the moment it can feel very lonely or very isolating, like I'm the only person this is happening to. And it's just not true. Right?
Especially if you fail, I think, at a higher level. So if you are, if you're bootstrapping something and you've raised a couple of $100,000 and then you fail, I think that's okay. But once you've raised millions of dollars, and then you have to deal with that.
Yeah, well, the stakes feel higher, or you feel like you don't want to let people down.
Yeah.
But there's a really important piece of this too, which is failure is not permanent, right? It is a temporary state. And even if one company might actually completely fail and go out of business, those same founders can start a new company, right? As illustrated in the corner shop example. But
Yeah.
we have, at this point, dozens of examples like that. Of the 300 investments we've actually made, roughly 10% of that portfolio, so it's like 33 companies now, are second or third or fourth businesses from Endeavor entrepreneurs.
Wow.
Sometimes their first company was a success, but a lot of times it wasn't, right? And we kind of still support them through the next company because the theory of change is about the entrepreneurs, right? This is sort of like we think the entrepreneurs are the ones changing the world.
Yeah, no, that's really wonderful. I mean, are there any examples that you think are worth highlighting just to inspire our audience a little bit in terms of like some of the successes you've had in your portfolio?
Yeah, look, I think here in this part of the world, some of the more well-known stories do illustrate what Endeavor's trying to do, right? So we can talk about Mudassir and Magnus and Abdullah and the amazing team at Kareem because they're a good example of this multiplier effect that I mentioned, right? And so Kareem was involved with Endeavor for a number of years. The guys were a big part of the community here in the UAE, but frankly also now in Saudi Arabia, where Abdullah is sitting on our board. Mudassir has actually helped us open a chapter for Endeavor in Pakistan. And this whole kind of studied idea of the Kareem mafia, right? There's now like 100 plus companies that have come out of folks at Kareem, exactly illustrates kind of Endeavor's whole idea that it's not just about one company being successful. It's about sort of the culture that you bring and the mindset that you bring and the way you're able to kind of inspire that next generation. And that is what we call this kind of multiplier effect that
Do you
happens.
track that?
We do. Yeah,
Okay.
we make these very cool looking maps.
Okay.
People can check them out online. But you can kind of look at one founder or one company and see who they mentored, who they angel invested in, former employees who left to start new companies.
Yeah.
And you can really track it. And it's very profound. And I would say, there is something to this idea of the compounding of human capital, right? We're all familiar with compounding because of Warren Buffett in like financial markets of how things compound over time. I think we underappreciate how much kind of the human capital actually compounds in these situations, right? And so Kareem's a great example. But I think about businesses we've supported here for a long time, like Property Finder, and Michael and his team. Katopi is a great Endeavor company. A lot of the companies that have been kind of in the headlines in the last year, whether that's Tabby, Tamara, Foodix, Maksab in Egypt, they're all part of the Endeavor portfolio. And that's kind of the point, is we want to support all the highest potential, kind of highest growth businesses in the region.
I've had Mudassir on the.
He was a guest, right?
Yes, on the podcast, and he spoke about knowledge compounding. How you accumulate knowledge over time, and
actually, I listened to a couple of your shows to kind of get ready for this conversation. I realized there's great examples because there's the Kareem example. Angami is also another example of
Kitopia as well.
Incredible resilience in a business.
They're a portfolio company as well.
Katopi, Angami, all of them are part of Endeavor.
More importantly, and I love your work because you invest in these emerging markets. So you're showing everybody that you can achieve amazing results by investing in Turkey. And I mean, we have, I saw it in your report as well, there's a unicorn in Lebanon, based out of Lebanon, Oyster.
Oyster, yeah.
Wow, right? And so you're demonstrating to people financially that there is a great return from investing in emerging markets.
Yeah, I mean, look, we've been saying this for 26 years, but it still is somewhat of a contrarian belief, but we really do believe it. I believe it in my core. Like, there are amazing people everywhere, right? There are incredible entrepreneurs literally everywhere in the world.
Yeah.
The thing that is not as well distributed are the networks of knowledge and expertise and know-how and capital that help companies grow and scale. And so that's all Endeavor's really trying to do at the end of the day, is connect those things together and leverage the natural human talent that's already there in all of these markets, right?
You said the word contrarian when you and I spoke ahead of this conversation, you mentioned something that Reid Hoffman mentioned about being contrarian.
Well, look, I've been really lucky to have amazing mentors to learn this business from, right? Like I didn't train to be a venture capitalist. I've been able to kind of learn this as we've built it over the last decade.
Yeah.
And when we were starting, Reid actually said something to me in one of our board meetings. It really stuck with me. He's like, look, at the end of the day, venture is actually very basic. He's like, it is not easy. It's not simple. Don't confuse it for that. But it is very sort of basic in what you have to do. You only have to do two things. First, you have to be contrarian. You have to really deeply believe something other people don't believe. And then you have to be right. Right. And you have to do it in that order. And I think it's a great quote, right? Because still today, well, I think there are more people who will believe in emerging markets or that you can build great companies from other places. It's still a pretty contrarian view. Right? Like I live in Silicon Valley. If you go knock on 10 doors, 9 out of 10, or probably 10 out of 10 are going to say, well, no. You can't invest in Lebanon. You can't invest in Turkey. You can't invest in Indonesia. And our real lived experience is you can.
I mean, why are we talking about Silicon Valley? Look at the capital that's flowing out of this region into the world.
Sure.
I read this morning, actually, there was a report by Sifted, which I think is a UK publication that says that
European ones.
I think $3 billion or something was invested by GCC countries into European startups. This is European startups, not US startups. Whereas if you look at the Magnet report, 2.2 billion was invested in the region, and this is not only regional money. I'm sure there's external funding, maybe not as much in 2023, but just to give you the idea that not much of the capital is being invested here. So it's not only a Silicon Valley
phenomenon
issue.
Well, it's interesting, right? You should never fault anyone for diversification. Like I actually believe a lot that you should be investing, with the right managers and in the right ways all over the world. So it's totally fine if bigger pools of capital in the GCC or the MENA region want exposure to Europe or Asia or the US. But they also should be investing here, right? And so I think it really is about doing all of it. In general, I think most family offices, most high net worth individuals, most asset allocators tend to be a little bit overweight their home market because of real estate, because of natural kind of reasons of being connected. Like they have more money invested in their home country or home region than they typically do outside. I think venture is sort of unique in that way because for years, it didn't work like that. People said, if I want to do venture, I need to invest my money in Silicon Valley, or I need to invest it in, London or in these other places. And I think what we're trying to educate the market on is venture capital is scaling globally. I mean, you can look at the numbers. There's now more dollars invested in venture outside the United States than in it, right? And that wasn't true at all 20 years ago.
Is it more or is it more like 50-50?
It's closer to 2/3 now is outside the U.S. Now that counts China, which is a big piece of it. But even if you kind of look at the whole world, it's about 1/3 of the dollars flow into the U.S. market in venture broadly, about 1/3 flow in China, and about 1/3 flow everywhere else. And I sometimes say we're focused on everywhere else, right? It really is about Latin America, Africa, the Middle East, the emerging parts of Europe, South and Southeast Asia. This is where I think there are still amazing entrepreneurs that are relatively undercapitalized, right? There's not as much capital in those places, and there's great investment opportunities.
And the deal terms are also interesting as well, right? Because you're not going in at these really inflated valuations, unlike the US market, for example.
Yeah, it's interesting, right? It's all a function of competitiveness. There's a ton of competition in the US for the best companies. You want to go invest in AI in Silicon Valley right now? That's a very, very expensive hobby to have. I would say in other markets, you do have more reasonable entry valuations, but there are still pockets of competition, frankly, that for the very best companies, there are smart investors trying to invest in them. And so you will pay, quote, more. I think that's a good point to make for people from outside the ecosystem. I don't think you ever really succeed in venture by getting kind of a bargain discount entry price, right? Because the best founders are going to be able to attract capital even in a market with less competition. And so, if you looked at a spreadsheet and said, I can invest in this brand new startup, this one is an entry valuation of 5 million, this one's 10, and this one's 20. And you just looked at the numbers. You're like, oh, I should do the one at 5. Like, that's clearly the best deal. It's very likely the case that that's not actually the best investment, because the slightly higher priced companies, it's a function of the market, supply and demand and the capital in the market. But, we tend to sort of be fine paying up for the best founders because, when you're aiming for 10x, 50x, 100x, if your entry price is 20 or 30% different, it doesn't actually matter that much in the end.
I think we're moving away from that here. I don't think people are extremely hung up on valuation anymore.
Well, I think they've started to see in some of the results that like the single biggest thing that matters in venture is being in the extreme outlier winners.
Yeah.
Right. It is very much a power law business. And so people are at this stage in the ecosystem, I think, very aware of that.
Yeah. How much does psychology play a role versus like the macro conditions? I mean, if we look at what happened over the past couple of years, there's been a pullback in venture capital here in the region. The numbers went down globally as well. So how much of it do you really think it's macro, like interest rates and inflation and, capital allocators putting their money somewhere else? And how much is it really like psychology or FOMO?
So my framework for it is, I think the long term is actually pretty macro driven. And this, funnels right into our thesis, which is over the next 5, 10, 15, 20 years, these markets are actually phenomenal places to invest, right? And so I think it's the underlying long-term macro fundamentals that really do drive the long-term behavior. But I do think the short term is pretty psychological, right? Because in the end, this is being practiced by human beings, not by computers. And we are all of us are just sort of this bundle of biases, right? We have recency bias, we have loss aversion, we have all these things that are driving our decision making. And oftentimes it's even worse in groups and committees and, kind of groups of people making decisions together. And so, I think a lot of it is kind of human psychology, or at least it's influenced or colored by the psychological components. I think the people who do the very best in venture capital, and frankly, probably in entrepreneurship, are the ones who have a little bit of an immunity to that, of what's going on around them.
Contrarian.
Yeah, because they say, hey, wait, everybody is, kind of worried about what's happening now. Like, this is exactly the right time to build a company, right? Or to invest in more company.
There's something from the report which I want to read, which your colleague, I believe, Jackie Camel, I hope I said
Jackie Carmel,
Carmel said. So she said, we don't stop investing because the market is going through cycles. We are steadfast in our belief of the power of entrepreneurship, investing through cycles and staying in the market where and when many are retreating. These challenging conditions are table stakes in our markets, highlighting the grit of entrepreneurs and why we continue to bet on them. I really loved that.
Me too.
I mean, I thought it was so beautifully written, and it's so true. You don't just pull out when everyone's pulling out, and you come in when everyone's rushing in. I mean, that's not how you do it.
It's exactly the exact wrong way to do it. Right? Is to kind of chase when
I'm no expert,
is super
right?
hot.
But I do feel that it's not what should be going on.
No, look, I think it's very eloquently written. Jackie's been my partner on the fund. She also lives in San Francisco for the last 9 years. She's incredible. But she really kind of nails the idea of what Endeavor believes in, which is we're playing this game for the very long term. There are going to be market cycles. Things are going to go up and down. And it's really investing through the cycles. This is true in the public markets too, by the way, but I think it's very true in what we do in private kind of early stage investing is going to have a huge impact. In this report, which maybe we'll put the link and people can check out, we actually do a deep dive on the ecosystem in Turkey, which is a place we've been working since 2007. And we show like just how many challenges there have been and how many things, have happened in that market. And yet, we have something like an 11x return on our aggregate portfolio in Turkey because we stuck with it, right? Because we sort of stayed throughout all the difficult times. And we have co-investors in some of those very same companies that ended up being big exits, but who at a certain point, they just threw their hands up and sold their shares for pennies on the dollar and got out. Like, oh, I got to get out of this market. And people are doing that today, right? In some parts of this part of the world, in some regions, they just think, oh, this is too much volatility. I can't do it. I can't be in this market. And we think that's a big mistake, right? I think if you're going to do this, you have to kind of play for the very long term.
Yeah.
It gets a little bit to that, there's this, I think it's a Bill Gates quote, but it was shared with me by a guy named Jason Green, who's one of my mentors, who's a Silicon Valley VC. But it's this idea that, human beings, we all essentially overestimate what we can do in 1 year, but we underestimate what we can do in a decade. And I think it's actually very true, is that none of us are actually that good at thinking about just how much we can do in 10 years or how much will happen in a market in 10 years.
Yeah.
The guys at Kareem we talked about, they did this amazing video of like the first 10 years of Kareem.
Yes.
And you look at it, you're like, oh my God, all that happened in 10 years. And so I think it's kind of trying to shift your mindset. And it's hard to do when you're younger, right? I mean, I give this advice to like 27-year-olds on my team, and they look at me like I have 3 heads because I'm like, you got to think in decades. You got to think 10 years at a time. But I really think it's a competitive advantage kind of professionally and maybe even personally if you can kind of really think long term.
There was a quote as well in the report, which is it's not about timing the market, it's about
time in the market.
In the market,
no, totally.
Which I thought was really, really
that's not ours, right? People say that all the time, but I think it's very, very true.
So it's turbulent now. There's down rounds. Valuations of these startups are being written down essentially, and they're trying to raise money because some of them maybe mismanaged the funds that they've raised before, and they're out of money, so they're going out for these extension rounds, etc. So again, going back to the psychology of VCs and what's going on. What's your read on what's happening, and like, what's your recommendation to VCs in this turbulence?
Yeah, so I have a strong point of view on this.
Okay.
Maybe I'll put a disclaimer out in advance, in case I offend anybody. But I truly believe a down round is not a bad thing, right? And I think it was actually at our investor meeting last year where one of our board members, who runs a big fund in Latin America, he said this most amazing thing of like, I have no idea why in the public markets, stocks trade up and down every single day, and we take that as being totally normal. And in the private markets, somehow we've gotten to an expectation that the price will only ever go up, which doesn't make any sense, right? Like companies struggle, they go through difficulties, macro environment changes a lot. And so we debated, writing kind of a blog post titled something like, don't let a down round get you down, right? Because the reality is lots of really good, well-performing companies are going to raise capital where their next equity round is going to be repriced from their peak 2021 round. And it might be the case that the company grew 300% and is going to raise at exactly the same valuation or a lower valuation. And our view is like, that's totally fine because we're not playing for the short term, like what is the price of this round? We're playing for the long term of where this can actually go. And so I think getting founders to support each other with that is actually really important because founders who get kind of artificially attached to a valuation, like, oh, my last round was X, I want to make sure my new round is at least X, doesn't matter, right? The thing that does matter for founders, and I do a lot of workshops and things on this, is actually ownership of their company and therefore like dilution each time they raise money, right? And so my golden advice, kind of the golden rule for founders is, every time you go raise capital, you're trading away a chunk of your business for money and hopefully know-how, knowledge, expertise. You're selling like 10 to 30% of your company, usually, right? And in most of the rounds we participate in.
And the Series A.
Yeah, in the A, really in the seed, in the A, in the B, the average is probably 20 or 25%. The point is you want to get something good for that 20 or 25%, and you want to manage your dilution so that each time you go raise money, you're somewhere in that 10 to 30% range, right? So you don't ever have a single funding round where you sold 70% of the company, right? That would be wouldn't set you up for success. But if you follow that principle of good dilution, it literally doesn't matter what your valuation is at any given moment, right? When you do the NASDAQ IPO and you're celebrating building $1 billion company, literally nobody says, what was your Series A valuation? Right? Like nobody remembers. But what matters is how much ownership in the business do you hang on to over time? Because, many of these business models will require a lot of funding. And so to build $1 billion company, you're going to raise money 4 or 5 times. So you just want to make sure you get the dilution right every time you do it.
But what about again, I keep asking. I feel I keep asking this question, but the psychology of it, right? So from the founder's perspective, but also from the market's perspective, whether it's existing investors or new investors coming in.
Yeah, so this is tricky, right? Especially because a lot of fund managers and GPs in this region are emerging managers, like first-time managers, and they have relationships to manage not just with their founders, but then with their LPs, right, and their capital source. And so there is a little bit, frankly, of kind of a perverse incentive for GPs to try to keep the company at the same valuation or moving up, where that's really a short-term issue for them. If they take the longer-term view, everybody should say, wow, 2021 was wild. Everything we did in that moment was mispriced. Let's reprice everything sort of correctly where it needs to be. And then we can get on to building the company, right? But we do need investors and people sitting on boards to also embrace that same mentality for it to be successful. Because frankly, if they push the entrepreneur to try to hang on to, let's say, a valuation number that doesn't make any sense, all that's really going to happen is it's going to hamper their ability to raise money in the market because the pricing is out of whack, right? And if you can't find a market clearing price for the company, then they won't raise capital. And likely, if it's still in this kind of J curve, right, of money losing in the first years of a startup, they'll go out of business. You know, and so I do think there are conversations happening right now, right, this month, this week, in some of these startups around, hey, we need to think hard about repricing the company so that we can raise capital and kind of keep growing.
And do you see, from your experience, I mean, you said you see a lot of investments and a lot of startups. Do you see this conversation being well received by, like, who's usually the bottleneck in that discussion? Is it more of the founder or the investors?
Well, let's think about all our stakeholders here, right? So you have the LPs who give the money to the funds, you have the GPs, the fund managers, you have the founders, and then you have the founders' teams, right, who all own kind of equity in the business. It tends to be that everybody is sort of worried about the level next to them, right?
Okay.
So the founders may come to a point for themselves where, like, okay, I get it, this is fine, but I'm worried about my team, right? And what is the team going to think, and how am I going to manage sort of the psychology of the company? And that's real. That's like an important thing to do.
Yeah.
And the experienced, mature, kind of serial entrepreneurs we work with, you saw them sit down essentially right away in 2022, once the world had kind of shifted, and say to their team, like, hey, look, this is a new ball game. Like, we're doing this differently now. The global macro has changed in such a way that our cost of capital has fundamentally changed as a business. And, you know, just so you guys know, we're going to need to make some changes because of that. That is also when you saw sort of layoffs and changes in growth plans and all those things. But the best founders had really kind of mature, matter-of-fact conversations, I think, with their teams. And I think the best investors are having those same conversations with their founders, and the best LPs are having those conversations with their GPs, right? And so I think it is all connected in kind of the stack of the ecosystem. But what we've seen in other places is that the quicker you can kind of have real, open, honest conversations about this stuff, the better. You know, kicking the can down the road is usually not a good strategy.
Yeah. Open and honest conversation, and also the idea that it's okay that this is happening. It's not your fault. Like, you didn't fail, or you're not you haven't lost, or it's temporary.
That's probably the most important message to any founder listening is, like, if we can help in this conversation we're having today, or if we as Endeavor can help kind of remove any kind of stigma or like negative energy from raising a down round, you know, maybe this is the best way to illustrate the point. At a retreat last summer, we bring together kind of Endeavor's top performing CEOs and founders from all around the world. And we go out in the redwoods in California for, you know, a weekend. And we had 100 of them there. And I was kind of moderating a discussion with 6 CEOs. 3 of them lead public companies, right? So US, New York Stock Exchange, NASDAQ listed, like, public businesses. And 3 of them lead private unicorns, right? And the 6 of them are talking. And they're talking about this issue of kind of market pricing. And what was fascinating was, to the guys running the public businesses, they had no choice, right? Like, their stock traded down, their price changed, they had to manage their employees, manage their investors. Like, it was just a market reality. where the other three were all like intensely discussing like how are they going to manage it and what are they going to do. So it's almost this weird function of the private market that it puts the onus on the founders and the investors to like take action in figuring out how to reprice and do this, where the public markets is just built in. It's automatic. It's like a mechanism that happens. But yeah, there's no stigma to it. The world changed, right? It's not like your company isn't working. Now let's separate it. Plenty of startups also don't work. That's okay, but that's a different case. But if your startup is working and the macro environment just changed around you, my advice is raise a new round, get some great investors, don't pay too much attention to the price, pay attention to dilution, right? So make sure you're in that kind of 10 to 30%. Get over it and keep going and keep building.
Some great things. What is your view on the valuations in the private markets versus the public markets? I mean, you invest in growth stages as well when these companies are raising their big rounds, maybe pre-IPO rounds. So what's sort of your view as a growth stage investor on that?
Yeah, so look, the later stage the company gets, the closer it gets to being a public company, the more tightly correlated those prices should be. And, people talk all about these kind of multiples on different metrics within a business. They should really start to match as you get to a privately held company that maybe is a year away from being public and a publicly held business. As you go earlier in the stage of the business, if you're talking about Series A or even seed or pre-seed, I think those numbers should then only really be kind of loosely correlated, right? Because the reality is, if you're making a seed investment, who cares where the public markets are today?
Yes.
That business is going to hopefully, if everything goes amazingly well, go public in 10 years, right? And so that's the only thing that matters. So people get a little too caught up, I think especially folks who come from finance to startup land, they want everything to be a perfect formula. And I'm like, guys, look, at seed investing, there's not a lot of math to do. Maybe you try to do a math problem on how big can this company be and what's the very tiny percentage chance it gets there. You multiply those together, that's probably a good way of making a seed valuation, right, for a business. But I don't actually think early stage investing should be that connected to public markets because of the time differential we're talking about. To your question, though, as you get later, then they're very correlated because you're actually figuring out, okay, if I invest in this business right now, is this a good entry price for when the company goes public in a year or two or three? And, they're not perfectly efficient markets, right? And so people talk about how much they lag or whether they lag or, this one performs better or not. One major difference, I think, today in the world in 2024 is you do have a lot of these crossover actors and players, whether that's the traditional kind of public market hedge funds, Tiger, Coatue, Dragoneer, who all came aggressively into private markets. Or frankly, you're now starting to have some of the world's best private investors, Andreessen, Sequoia, and others, say that they're just going to continue to play into the public markets. The more pools of capital and the more kind of decision makers and capital allocators that cross over, the more efficient those markets are going to be. There's not going to be that much lag one way or another because you have literally the same decision makers kind of playing in both
because
markets.
We saw that private valuations are way higher than what they're getting when they go public.
Yeah, and look, it went in both directions, right? But there was this idea that the public markets were ripping, so all the crossover investors came into privates. Enough capital flowed that way, they essentially inflated privates. So then privates were kind of too high.
Okay.
The public markets crashed back down. Now there was sort of the exact same problem, but the other direction than what they were originally taking advantage of. And it was just, again, it's a supply and demand issue. It was just kind of where the capital flowed at the different stages. Ultimately, I think the markets are pretty efficient. These are sort of like temporary dislocations that people try to take advantage of.
When you invest in emerging markets, do you see, for example, like a sort of a percentage allocation into venture from, like, let's say, the overall size of the economy? So I was looking at the Middle Eastern economy, for example, we're a $5 trillion economy. $2 billion was invested in VC, less than 0.1%.
Yeah.
So you talk to a lot of decision makers and policy makers, capital allocators. So what can we learn from other emerging markets, let's say? Because if one thing we've learned from your experience is that these markets can produce high growth companies.
Yeah, I guess,
and great returns.
The message we're trying to send is that this isn't about a government trying to stimulate something artificially. This is a real, supply and demand, like market-driven thing, that there are great entrepreneurs, great founders, and therefore great investment opportunities in the UAE, in Saudi, in Egypt, in Turkey, in Pakistan, in all these different places, right? And I think I want more global investors to hear that and to recognize that, but to approach it in the right way, the way we are, which is to say, this is a very long-term investment, right? Because I think one of the hardest challenges to this as an asset class is its long-term illiquid investing, right? And even with some of the LPs we've had join our funds, we've invited a lot of families and high net worth individuals and our own entrepreneurs to invest in the Endeavor Catalyst funds. Many of them, it's their first time investing in the asset class. Like, we're their first venture fund they've ever backed. And sometimes we get a phone call 2 or 3 years in and say, can I sell my shares? And you're like, no, you can't actually. Like, we're on this journey together for a long time. I think that's important for people to understand how that works.
Good. So on that, I mean, you raised a lot of money. So what is your advice to emerging fund managers potentially in terms of their LPs? Like, what are the red flags, the green flags?
So I'll start by saying, I think emerging managers, particularly in emerging markets.
So these are first-time fund managers.
Emerging manager is essentially a new fund manager. Typically, the definition is they're on fund 1, 2, or 3, right? You're still kind of considered an emerging manager. So I guess we were an emerging manager for a decade until we raised fund 4, a year and a half ago. But I truly believe emerging managers in emerging markets might be the single best kind of dollar for dollar place to put your money in the world today in terms of risk-adjusted return, right? I think it's going to outperform as an asset class. Now, I think need diversification. So you shouldn't only invest in one fund, but investing in several of these emerging managers. This is kind of a note to LPs and
why do you say that?
Oh, because look, I have a thesis about emerging markets that I think is true. And then who's going to really have the best access to those companies at early stages? It's going to be new fund managers, right? And so there are some established VCs in this region who maybe now are past that fund 3 stage, but they're very few.
Very few.
Right? And so if you think about who is going to get the best returns in the next 10 years, they're fund managers that are on fund 1 right now, or fund 2 right now, or fund 0, like they haven't started yet. I think that's a great place to kind of put your dollars in the next decade. My advice to the managers is, just keep hustling. Because fundraising is not easy.
You told me you did for your first fund. Was it for your first fund? You told me you did 800 calls or meetings.
Well, so fund 1, we were lucky enough to have some
people
folks,
should hear that. By
some
the way.
folks on our board were supportive early on.
Yes.
So that the first kind of $10 million we raised, which was actually donated money, we had a lot of kind of internal support. But it was our fund 2 was the first time we really kind of went out and had to raise a fund from LPs. And the numbers are true. They're not made up. I did 800 pitches, 800 kind of, introductions of the fund to people to get 200 LPs and raise $80 million. Now, the strategy was not pitching the sovereigns or the pension funds or the big pools of capital. It was doing this with individuals and family offices, but it's a hustle, right? I mean, that was 18 months of my life. This is also pre-COVID, so doing this on Zoom.
So you're traveling.
There's a lot of airline miles.
So you're on the plane.
A lot of sleeping on the plane.
Oh, wow, okay. But that's important for people to hear. I mean, even for you coming like from Endeavor with sort of the umbrella of Endeavor, and still you had to make so many meetings to get the 200 LPs. Yeah,
so I think the category of kind of emerging managers in venture is very much a underappreciated. I don't want to call it a secret, but like I think people don't really recognize or understand the value, and so you still have to sell and pitch a lot to get people to believe in it. I see this from. We talked about this before the show, but I sit on the board of the Kauffman Fellows, which is a Silicon Valley-based kind of network for GPs, and a lot of them are emerging managers. And frankly, I see people with like amazing theses who I know are going to do incredibly well, and it's still hard to raise money, right? And so the best advice to emerging fund managers is like, keep at it, don't give up, be resilient, be incredibly persistent, because that's really, I think, what it takes to raise those, fund one and fund two.
Red flags from like when they're talking to potential investors, potential LPs?
Don't overpromise. Meaning, we're all, I think anybody in this business is kind of wildly, irrationally optimistic about things, but, tell the truth, tell people exactly what you're doing and when you hope to do it by. There's a temptation, I think, founders fall into this trap and emerging fund managers of, hey, I want to raise $50 million. And I had a good meeting with this guy where I think he might invest $1 million. He might invest $1 million. Don't go into your next meeting and say, this guy committed $1 million. Because guess what? The new person you're talking to is going to call the first person right away. And so this is a reputation business. And really, I think your name and your reputation is kind of everything. And so my advice is be very transparent, build trust, be very clear. The red flags would be, avoid anything that's kind of overselling or overpromising.
But on the LP side?
On the LP side. Well, it goes for founders with GPs too, right? But it's the same advice for, I think, managers working with LPs. Assume everyone knows each other, right? And so act in anything that you say, like the LPs you just saw yesterday are literally sitting in the same meeting with you, right? So meaning be very clear and transparent about what you're doing.
What are you looking for when you meet these great entrepreneurs? So also this is in terms of advice to the people who are listening, who may be entrepreneurs or might be considering starting a business. So what are you really looking for?
Yeah, it's a good question. I try to think about this, not just personally, but kind of with Endeavor, having looked at, we've screened thousands and thousands of founders over the years. And everybody wants to know, like, what's the secret magic way to know that a founder is going to build something? And I think it's very hard to tell.
I've had people ask me when we're investing in the company, they'd say, like, do you think it's going to make it?
Yeah. I mean, obviously, yes.
I wish
right?
I knew.
If we're investing.
For
but,
sure.
I think there's two ways to kind of separate this. One is Endeavor's done a bunch of work now. We have an internal think tank called Endeavor Insight that's put out a lot of work on founder pathways, which actually looks at the journey that somebody traveled before they became an entrepreneur.
Okay.
And there's this kind of generic assumption that, they probably went to like an Ivy League school
McKinsey.
or a top business school. They worked at McKinsey. They did X, whatever. That can be a pathway for a founder, but it's the minority of the cases.
Okay.
Right. And so it turns out things like experience working at another high growth startup are actually super, super important. Going to a solid sort of educational background, but that might not be a brand name, but it's actually just a good place where you learn how to think and how to work and how to do these things is also an important indicator. We've actually mapped out, a few hundred of these kind of unicorn founders, both in emerging markets and the US, and you can see exactly the path they traveled and what they did. And the conclusion from it is there's no one secret thing that like it has to be McKinsey or Stanford Business School or whatever. There's lots of different paths that can lead to a successful founder. The second piece of it, though, I think is more human. And it's really this idea of trying to find people who are anchored in the real world. So they kind of understand the reality around them, but they do see the future, right? They kind of see something that doesn't exist today and think that's what I'm going to build, right? And people use this word visionary. Endeavor was started by a visionary, this woman, Linda Rotenberg, who's still our CEO and my boss. And the way Linda's a visionary is she mixes up her verb tenses, meaning like she talks about stuff in present tense that we haven't built yet, right? Like it's like a program we're going to start next year. But once she has kind of visualized it and seen it, she's like, oh yeah, this obviously already is here, right? And so there's a quality of people who I think are anchored enough in reality, but really kind of believe in and see a different future that makes for great founders. But you can't do it alone. And so the other quality I think that Endeavor has learned to really look for is people who have a certain amount of ability to attract others, right? Whether that's to attract employees, to attract funders, to attract partners. And, this isn't always manifest as a charismatic, outgoing, gregarious person. Like it can be of many different personality styles, but there's sort of an attractiveness to their leadership that when you sit with the person for 10 minutes, you say, oh yeah, I want to work with this person. I want to follow this person. I want to, whatever journey they're on, I want to be there with them. And that is a quality that seems to sort of transcend cultures, religions, languages, right? Like it's kind of everywhere that Endeavor works.
It's that feeling you get when you're with someone.
Yeah, and you hear this, people say like, oh, I know in 5 minutes, right? Like, I don't know if you always know in 5 minutes. But the point is, there's something kind of innate, intrinsic, feeling-driven that is real about how people make decisions and where they decide to put their time and their money. And there's a quality related to that all the best founders and entrepreneurs have.
And traits, because everybody talks about, they want founders that are resilient and tenacious and patient. But then the question is, how do you see that?
Yeah.
Because I had GV on the show as well, who I'm sure you know, and he said, he tries to see if they've been through rough patches, throughout their careers. But then he said something interesting, is that everybody has learned to be a really great storyteller.
Yeah.
So you need to be,
true.
It's
funny, right? Because in a sense, we're playing in a marketplace, right? So if the world's best VCs say, here's what I look for, the world's best founders get very good at telling exactly that story.
So everyone wants to change the world.
So here's the thing. I think it's actually very hard to know and hard to test for some of this stuff. So people obviously will ask questions about background to understand, like, where are you coming from? What have you done before? What's kind of made you you? The qualities that I look for, and I think that this kind of is imbued into a lot of what Endeavor's doing. We talked about, I'm part of an early stage fund called Alter that is also emerging market focused, where we're investing pre-seed and seed like super early. And so there isn't that much to go on in terms of the businesses. Right? And so it really is about evaluating the person. And, the things I think we sort of over-index for in Alter and in Endeavor, and frankly, even in Kaufman Fellows, is we do look for people who have this quality of kind of radical self-belief, right? They just like believe in themselves very profoundly. And, truly, it's a level of self-confidence that will allow you to kind of run through brick walls and do impossible things and, still believe in yourself when 50 people in a row say no to your idea. That radical self-belief, I think, really matters. But it has to be kind of married with or coupled with a deep intellectual curiosity about the world, where you don't just assume you know every answer to everything, but you're actually really curious in how things work and why they work that way. Because I think intellectual curiosity is ultimately what manifests later in careers as humility and even sort of servant leadership. And so those two things together are a very powerful combination. So if you just have that radical self-belief, you might end up just being an arrogant jerk, right? Like,
exactly.
You're so full of yourself.
Exactly.
But if you have that radical self-belief and the intellectual curiosity that is going to essentially later in life kind of turn into humility and the ability to be humble and listen to others, that's kind of a superpower if you put the two things together.
And how do you see that play in action? So once you've done that investment, these entrepreneurs are building these great companies. Are there common traits that you see in the really successful companies that are being built?
Most really successful founders are actually, to that second point about kind of intellectual curiosity, they're learning machines, right? They're incredibly good at getting exposure to new people, new concepts, new ideas, and figuring out how to incorporate that into what they're doing and what they're building. And, Endeavor is fundamentally a mentorship kind of network and organization. What I find is that the very best founders, they know how to kind of get the most out of their mentors. They know how to get the most out of conversations. And frankly, it's not that they take every single piece of advice and just start doing it. They know how to kind of filter it and figure out from all the different things they're hearing, what really are they going to take and apply to themselves and to their business. And that's where the radical self-belief part comes in, because, I've seen founders who say like, oh, it's all about mentorship. So whatever the mentor tells me, I'm going to do it. That's not really the formula either, right? It's about having a really solid core of what you believe is true and then figuring out how to add over time as you go. And I think that's true in most every famous Silicon Valley story you can study, is that all these entrepreneurs, high degree of self-belief, but really, really incredible learners, right? Because that's what it takes to iterate and be successful over time.
think Noor Swed once told me, strong opinion is loosely held.
Yeah, that's a good framework for it.
Or something like that. Yeah, it's great to learn from people who are actually doing things and get direct insights into what's happening, especially when you have access to some really successful founders that are building great companies.
Yeah, I mean, my best friends and even my wife all make fun of me because I come home from every one of these trips and, we go to kind of crazy places, right? I'll spend time in Pakistan or Lebanon, and I'll come home and say, like, man, you won't believe how good things are going in Lebanon. And they're like, do you even read the news? Like, do you see what's going on in the world? It's like, okay, yeah, I understand all that's happening. Yeah. It's complicated, but there are amazing entrepreneurs and founders building companies in all these places. And I think, if people focus kind of their energy and attention on that, the future has some very, very bright possibilities in it, right? And I think it's exciting.
What is the narrative that you go back to the US with once you've been in the Middle East?
I spend a lot of time in the US just trying to convince people that the rest of the world exists, and especially in Silicon Valley. And what I mean is, like, there's this very sort of inward-looking, insular thing that I think is still pretty persistent today. And so just trying to get people to think about Asia and Africa and Latin America and the Middle East, I think matters a lot. But I do think, unfortunately, still today in the US, people don't have a very nuanced view or understanding of this part of the world, right? So even coming on this trip, I had friends say to me, "Oh my gosh, you're going to the Middle East, be careful." And I'm like, yeah, no, I'm going to Dubai and Riyadh and Abu Dhabi. Like, I'm not going to any of the places you're reading about in the newspaper, right? So, I think there's a long way to go and a lot of work to do on that. But I also believe that we can connect this region and this part of the world to some of the best talent and best investors and best capital allocators in Singapore, in London, in other parts of the world. So I don't think it's all dependent on, getting the US to recognize the value here. I think there's a lot of other great markets we can connect this region into.
Do you advise founders in this part of the world to think global from day one?
Great question. It depends a lot, right? So if you are building a type of business,
like a B2B software business.
Yeah, so many of those companies are going to be global from day one. But frankly, I think those come later in ecosystem development of emerging market kind of venture and entrepreneur ecosystems. So the first wave of companies, which we've seen here, is all the consumer and commerce type businesses, right? So think Souk, Talabat, like, even Kareem, like all that kind of first wave consumer stuff. Then you build digital infrastructure to support consumer. So that's payments and logistics, basically. The next big wave of companies is technology coming to disrupt the biggest parts of the economy. So transportation, healthcare, education, financial services beyond just payments, real estate, food and beverage, even agriculture. And only after that, in kind of the third wave, I think, are you starting to build true enterprise software type companies. 15 years in, this is what's starting to happen now in India. It's starting to happen in Brazil. It's still not really happening in terms of a ton of B2B enterprise in the Middle East or Africa or even Southeast Asia yet. But it'll come, it'll happen. And then, there are amazing sort of global from day one businesses being built in these places, right? So I'll highlight a couple here that are happening. You talked about Oyster, which the founder's originally from Lebanon. Global business, really kind of now being built with a totally remote, distributed, everybody works everywhere kind of workforce, but it started here. There's a business that came out of Egypt called Instabug that isn't necessarily in every like tech conference and list and thing happening here because they're quietly building a super global product, which is a debugging software for developers. Yeah. And they're doing it mostly with engineers in Egypt, but it's going to be a really, really big global company, right? And so I think, if you look at our portfolio, about 75% of the investments are regional leaders in businesses people will know and recognize like within the region, and about 25 or 30% are these kind of global innovation comes from anywhere type businesses. And so, this kind of question of, well, should you think global from day one? Well, it does depend a lot what kind of business that you're building.
I think one of the other companies as well that had a recent exit, I think, was InstaDeep, right?
Oh, yeah, that's a great one.
Yeah.
From Tunisia.
Yeah.
Right. And so, yeah, I think our single biggest exit for our funds in 2023 was an AI business born out of Tunisia, right? And it got acquired for $700 million. And that was definitely global from day one. The company played a really interesting role in the COVID detection early on, and ultimately got bought by a European player. But yeah, what a cool example of innovation comes from everywhere.
Yeah.
In this different way.
Well, thank you so much, Alan, for stopping by.
Of course. Thanks for having me. It's great to see you.
Thank you.
And to everybody listening, keep building what you're building.
Yeah.
Start investing in startups. I think there's a lot of positive to come in the next 10 years here. And I encourage folks who are not part of this ecosystem today to get involved.
Fully agree. Thank you.
Of course. Thanks for having me.
Thank you so much for tuning in to this fantastic episode of Conversations with Loulou with Alan Taylor, the managing partner of Endeavor Catalyst. I hope you found it insightful. As usual, don't forget to visit conversationswithloulou.com to check out all the other episodes. Make sure you subscribe wherever you listen to or you watch this podcast and leave us a rating and a review. It really helps in getting the show discovered. Don't forget to spend a few minutes on the podcast listener survey. You can find the link to that in the show description. Please spend 7 minutes. It's anonymous, but it really helps me in getting to know you better. I'll see you in a few weeks.